Good morning and welcome to Coffee with Tom and Joanne. I'm Tom Matthews.
And I'm Joanne Taranto. Thanks for joining us today. We have a great topic to discuss, and we wanted to bust a myth in real estate. That is, a lot of first time buyers think that you have to have 20% to buy a property. A 20% down payment is kind of the gold standard. However, what other options are there, Tom?
Yeah, Joanne, great topic. And I'm really happy to be talking about this because that myth is something that has been around for, 50 years. And it's just not true. If you look to the National Association of Realtors, they have a guide that they publish every single year. And typically the average down payment nationally is like 7%.
Yep,
And, people, their eyes light up when they hear that because, life is expensive. You have student loan payments, you have car payments, you have rent payments. It's hard to save money. So, for people out there that are like, man, I really want to buy, but I don't have 20% down, I want you to watch this video. So,
yeah.
right now, if you have served in the armed services or are currently in the armed services, you can use what's called a VA loan, which will allow you to put as little as 0% down and not pay primary mortgage insurance and still have access to the best interest rates. It's
That's
the
right.
way that the US government says thank you to their service people. The next thing, if you're a conventional buyer, you can buy with as little as 3% down and do a conventional loan. You may have PMI, depends on what product the bank is offering. But Joanne, what's the big loan that people talk about? FHA. What's that down payment look like?
Yeah, so with an FHA loan, you can put as little as 3.5% down. And FHA loans have not been as popular in the last couple of years just because of the low interest rate environment. But FHA loans are an excellent product for people to buy into properties with low down payments or to access better rates. Because sometimes the pricing on an FHA loan can be advantageous depending on what your situation is. So it is a little bit more detailed, just like the VA loan. It requires a few extra pieces of paper, but it's no big deal, and it's a great opportunity to get yourself into a home. And using these lower down payment programs is not only an advantage to those who maybe don't have 20% to put down, but let's say you do have 20% to put down, but you want to buy a house that you want to fix up, right? So maybe you decide, I'm not going to put 20% down on this because I need to do X, Y, and Z to make this home habitable for me. And so you may opt to put less down, put 3, 5, 10% down, and then keep the cash in your pocket to be able to have liquidity after closing to make improvements.
Right.
So it's more than just, you know, products for people who don't have the savings of 20%. It's products that offer you the flexibility to kind of do what's right for you.
Right, because I mean, there is access to commercial construction loans,
Mhm,
but like a typical construction loan, you have to put 30% down.
mhm,
There's something called a 203K loan, which is a rehab loan,
mhm.
which is great because you can do the low down payment and you can get money to do the rehabilitation. But I did one of those recently with a client, and it's a lot of work. And it's a lot of work because you have to get all the pricing and then you get the money gets distributed when the work gets done. So if
Mhm.
you want more freedom, that's where keeping your cash in hand and doing a low down payment loan is advantageous,
Mhm.
particularly if you want to do the work yourself, because you really can't do the work yourself with a 203K loan. You have to hire other people.
Yep.
So if you're a handy person and you're trying to buy a property, and say right now you're paying rent for a two-bedroom apartment, you're paying $2,500, and you could do a 3% down on a fixer upper in the
Mhm.
payments $2,400. It's kind of a no-brainer to buy the property because you're
Right.
building equity, you got your own property, and you get typically more space, right?
Right.
So Joanne, say someone wants to buy a property with, 5% down, but the closing costs seem to be a little bit of a hurdle because they have the 5% down payment, but after closing costs, money feels a little tight. What are some options that they can look at in this marketplace?
Yeah, that's great. So there are some options out there for buyers who would like some assistance with closing costs. So the first thing I would start with is talking with your lender about what the projected closing costs are for a loan that you're looking to get, so that you have an idea of what it will cost you to buy the property with a down payment, and then how much money you need to come up with for closing costs. Because we're all about financial health and people staying well within their comfort range and continuing to keep their cash flow in a place where they don't feel house poor.
Right.
So in this scenario, you can talk with your lender and see what they oftentimes a lender may have a credit for, some reason, or maybe they may have a relationship with your employer where they have credits available. The other option is a seller paid credit. That is a great opportunity for buyers. And the way that you structure that is when you make an offer on a property, you would then include a contingency on the offer that says, seller to provide up to X, or seller to provide X number of dollars to pay for prepaid taxes and insurance, or a loan or a rate buy down. Sometimes folks are doing things like 2 or 3-1 buy downs right now, where the seller will pay to buy down the rate on your mortgage for 2 or 3 years. And those are great opportunities for people who are maybe finishing up med school and who are going to be making money in the next couple of years, but are in a position now where maybe their family needs to move now as opposed to
Right.
later.
Right.
So the way that a seller paid credit works is that it basically comes off the net dollars from the seller. So at closing, on the closing disclosure, let's take a round number like 5,000, and they will take $5,000 out of their proceeds in order to pay off some or all of your closing costs.
Right.
And the seller can contribute, what is it, up to 3%, Tom?
3%. Yep. Fannie Mae guidelines as of today, which is in late November, is they can put 3% towards the buyer's closing costs. So if you're buying a $400,000 property, you can get up to $12,000 in a closing cost credit. So that comes off the seller's net dollars, but it does get looped into your loan. So for the buyer, you are kind of financing that $12,000 over the life of the loan. But when you amortize money over 30 years, they typically say it takes, I think, 7 years to be in the property, paying it off, to have get that money back. So
Mhm.
oftentimes it can be a really great solution for buyers, because what can happen is that a lot of people don't stay in a home 7 years. So they sell within that and they move on. And so that money up front was super helpful. Or
Mhm.
maybe if you're doing sweat equity, we call it, doing the work yourself, and you refinance the home, if it appraises for more and you can kind of change your loan product, then that cash gave you the opportunity to make money in that regard. So I think
Right.
it's an important product to know about.
Yeah. So, I mean, there's also one other product that we haven't talked about, and that's mass housing.
Oh yes.
And mass housing has as little as 3% down, and it's a product that has income limits,
Hmm.
but is a great, great program for people in Massachusetts. And if you
Yes.
qualify for a mass housing loan, it really oftentimes the pricing and the rates on it are more advantageous than you think.
Yeah. Yeah. And
So,
I think it's just important for people. A lot of people say, like, I shouldn't be buying a house if I don't have 20% down. And that was kind of this old rule of thumb that basically said, when you put 20% down on a property, it means
right.
that you have like financial incentive into the property. But I also think that mentality came from when houses were $60,000. Right. So when a house was $60,000, 20%, you get 12 grand into the property, you got a stake. But
Mhm.
now with properties at $400,000, you put 5% down, you still get 20 grand into it. I mean, that's still a lot of money.
Yeah.
And if I'm putting 20 grand of my hard earned dollars into a property, I'm not going to just arbitrarily walk away from it because things get tough. And
Right.
that's like what old school people say, is that if things get tough, if buyers don't have a good down payment, they're just going to walk away from the property.
Yeah.
But, walk away from a property has a lot of ramifications, from,
Right.
foreclosure, bankruptcy, short sale. Doesn't
Yeah.
matter how much money you put up. And so we feel that people care about their credit,
Really.
and owning a property, even if you have the low down payment, you have the opportunity to build equity
Right.
rather than paying someone else's mortgage by being a renter.
Yeah, I mean, nobody ever talks about how rent is 100% interest.
Exactly. Exactly, Joanne. That's such a good point. And when you
So
own a property, you can just do what you want to do,
yeah,
and you have the freedom. My wife and I, we have chickens. Can have chickens on a rented property,
right,
and you
right.
have a garden. You can just do what you want.
And I think it's important that, if you're considering buying a piece of real estate and you want to take advantage of one of these programs that's less than 20% down, have a conversation with us, right?
Yeah,
Have
for
the
sure.
conversation. We will help you to look at your situation and decide if this is the right thing, because sometimes it's not the right thing to do.
Right,
It's not the right time to buy real estate if you don't have any kind of permanence with your job and your
right,
job may go somewhere else. In that case, renting is probably the safer, more advantageous thing for you.
right.
But you won't know these things until you talk to somebody who really is kind of in the business of doing that. And we can also refer you over to a great loan officer who can look at your full financial situation. We could also refer you to a financial planner who could take a look at what your savings are and figure out, how budgeting for a house or saving for a down payment can be done easier for you.
Yeah, agreed. Agreed, Joanne. That's very good. Well, listen, thank you to everyone for coming out and listening to Coffee with Tom and Joanne as we talk about low down payments. I'm
Yeah.
Tom Matthews.
And I'm Joanne Taranto. Cheers.